Glad to have you here today.
Absolutely. This is Wade Como, and I want to thank Leah, first of all. A lot of great information. We also appreciate the enthusiasm and feel very similarly. We are still investing and believe that this is going to be a little bit of a challenging bump in the road, but a bump in the road, and that the people who are confident whenever there are times of distress are the ones who typically do best in almost every market. So we're definitely aligned in that. I also want to say that we recently changed property managers and moved to OmniKey. So any of the people who are on the phone that are not currently a client of theirs, we are big believers. We moved our portfolio and the customer service and the positive responses from our tenants, and just everything has been a complete 180 from where we were before. So we're big believers in what they do. Whenever Leah says that she is available at all times, that's absolutely true. Her and her staff have the same passion for customer service, kind of from top to bottom. So before I dive into what we do, I just wanted to say that we're really excited about being a part of her team. And if you are not currently, I strongly encourage you to check her out and her team.
Thank you so much, Wade.
No worries. So first of all, I want to talk a little bit about what we do. And we really try to focus on being a one-stop shop for investment lenders. And we really look at trying to provide both the short and a long-term financing, including conventional loans, not only with one company, but also with one loan officer. So in most instances, you can qualify for multiple products with one credit pool. You're going to have a single point of contact, a highly experienced licensed loan officer that handles both hard money and permanent financing. Then we also have an internal multifamily and commercial specialist. I tend to agree with Leah. Commercial is definitely the most unstable part of what we're seeing out there right now. But with that said, there are probably going to be some discounted opportunities over time. We do want you to know that we provide those services as well. We can go on to the next slide. Jeff, you want to take this one?
Sure. So for you guys that don't know us, we are a lending company that was founded by real estate investors. Before we started doing loans, we built up a pretty sizable rental portfolio, like Wade was saying. We do our flips ourselves. We're very involved, and we have our project manager. We're very involved in the real estate business outside of just lending. We've completed, when you count loans and transactions, we've done over 800 deals. And we think that the perspective that we have as investors will really help you guys that are maybe newer we try and minimize the mistakes that you guys might make as a new investor, right? So that means every step along the way, we're there trying to hold your hand. Obviously, we aren't consultants, but we try to think of ourselves as a second set of eyes, right? So if you're somebody who's doing a flip loan, for example, we always have our own project manager walk that property, confirm your rehab budget, make sure that your plan and the numbers that you're seeing are what we would see as well. Thank you. Most of our clients are referrals, repeat customers. We have a lot of, like I said, we offer a lot of products, internal, external, same point of contact for everything. And like I said, it's not just the flips, it's also the buy and holds. We will have our guy typically go out and check out the buy and hold deals as well.
Hey, Jeff, will you do me a favor? Will you pull your mic back just a little bit so that it picks it up well for the recording?
Sure. Is this better or worse?
It's about the same. It's just reverberating a little bit.
Okay. I'll try something else. Y'all go ahead. I'll try to fix this on my own.
Oh, good. No problem. We can hear you. It's just loud.
Got it.
Okay. Jeff and I, to give you a little bit of background, we were both in lending, traditional lending for a long time. And we actually worked at large national banks and moved into investment first. We started, as Jeff mentioned, adding rentals very heavily, also doing flips, doing things wholesaling, and then we back in our previous lending experience with the complete objective of being lenders for real estate investors. While we still provide owner-occupied cash-out refinances to a lot of people, we've done a lot of those recently to fuel their investment business, or we can do an owner-occupied refinance to lower your rate and save money on your monthly payments. That is an ancillary thing that we provide for clients. but we do not work with typical real estate agents representing buyers of homes or representing sellers of homes or anything of that sort. Our focus is to work with agents and other contacts exclusively in the real estate investment space. Well, I did want to give a couple of lending updates in this particular space. You know, most hard money lenders out there raise their money in one of two ways: commercial banks and private individuals. We are very well capitalized and have a lot of great contacts, so we see no reasons whatsoever that hard money loans are going to stop down in our particular business. I've heard maybe some very small operations that may be pulling back a little bit, but most of the larger hard money players out there have confidence and are moving full steam ahead. On conventional loans, you know, that is a big way in which the federal government props up the housing market and also just the overall economy. So they are definitely going to support this effort, and it's going to be a channel that is there for real estate investors. And Fannie and Freddie have already made some positive changes. I will say that whenever these changes are rolled out, sometimes there's a little bit of gap in time between, you know, federal regulators giving positive changes, some of which came out yesterday, which are the ability to do drive-by appraisals, not having to get into the property, or desktops, and then also making it much easier to document income because some verifications of employment might have been a little bit tougher with some people working from home. But these are just the first of many changes. We think we're going to see far more. We believe that that's going to present an opportunity, maybe in a little bit of a short window of discounted pricing, but maybe far more favorable products in this category to allow you guys to expand your business. I do want to mention one thing with appraisals outside of that, and that is merely that it is taking a little bit longer to get appraisals in, just because of the overwhelming amount of appraisal requests because of the refi boom and some other things. So we can still close loans very quickly on hard money loans. You know, we can typically close them in about 7 to 10 days, sometimes a little bit quicker if you need a special situation. But I will say in general, those appraisals are taking a little bit longer, but it's only a positive because there are so many people wanting to take advantage of the situation at this moment.
So Wade, can we take a step back for a moment? And some of the people, this is a gigantic webinar. This is the second largest we've ever done. And it's because we're starting to talk about these pre-owned plays. And so let's kind of go back to bare basics and let's talk about what a hard money loan is and how and why it's used.
Absolutely. So a hard money loan is a loan to purchase and repair distressed real estate. In most instances, you cannot get one of these value plays to purchase a property on a straight conventional loan. It's not going to meet the standards that are required in order to go straight into that product. So we have worked diligently to provide a very efficient process where you can take advantage of a hard money loan. You can buy a distressed property. Candidly, most of the offers that I've made over time and most of our clients make are often a cash offer. They did not put a financing contingency because it is a hard money loan. I will give one caveat there. If you have a sophisticated seller, i.e. a bank, it's an REO or a short, there is something very specific that takes place in the deed that makes that problematic. But if you're dealing with most sellers or if you're buying from wholesalers, it's not going to be a problem to make a cash offer there. And in most instances, they're very familiar with hard money. And most wholesalers look at hard money almost comparable to a cash offer. But this allows you to close in a very quick time frame. The qualifications are much easier to get qualified for. It's a more efficient process. It's not as arduous to get qualified or to provide the documents. And we will give you the money and reimbursements to make the repairs on the property. So we do very small rehabs in certain instances. We've had some people who use hard money just to close very efficiently because they have a deal that has to close in 5 or 7 days. But in most instances, it provides people the capital to make repairs so that they can get that discounted property.
And to kind of give you all background on my personal acquisition, you watch and see these crazy projects that Michael and I do. Everything that we do started in hard money. So when we first started doing this process, before we had all the money and the success and everything we have now, we were using hard money, and we used hard money for a long time. So most of the top players, that is where they start.
Absolutely. And there is a process that people go through as they grow, but early on, we think that this is an outstanding option for newer investors or people who may just not want to go through the trouble of filling out a personal financial statement and some of the other complications that come along with working with some of the banks.
Yep.
Anyway, we're gonna cover several other topics here. We're gonna cover hard money versus going to conventional financing options. Conventional financing retirement plan option, which is something that we find has been very effective for people who have a significant net worth to be able to take advantage of this product, even if they're not currently working or currently have a W-2. We're going to cover several other options here. I won't go over each one. We'll just kind of go through these topics as we go through the pages. Jeff, do you think the mic has worked out? Do you want to take this next one?
Can you guys hear me okay?
Oh, so much better.
Yes.
All right, good deal. Okay, so hard money loan programs, like Wade was saying, we have, this is for purchase, this is a loan to purchase, acquire, repair, and then at the end of it, you either sell it if it's a flip and pay us off, or you refinance it into a long-term loan and pay us off. But we have deals, our hard money rates, they start as low as 6.99 for very well-qualified borrowers. That rate stays that way for 60 days. It's a discounted rate for our buy and hold customers if they qualify. The logic being it's usually the buy and holds are smaller rehabs, and we've done a lot of work trying to make sure that you can get in and out of the rehab, meaning you buy it, you fix it up, and then you're refinancing within that first 60 days. So it's a discount rate for 60 days, 6.99 and 2 points for those who qualify. For you newer investors, a point is basically just 1% of the loan amount. So on a $100,000 loan, 1 point is $1,000. Like we mentioned earlier, we close in as little as 7 days. You can go up to 75% loan to value of the ARV, and what that means is, let's just say you have a property that once it's fixed up, it's going to be worth $100,000. We will lend you $75,000 on that deal. So if you can buy it and rehab it for 75 or less, then that's great. You can bring nothing to closing but your closing costs. We do have a VIP flipper program for seasoned investors. This is for people that are experienced, well capitalized, good credit. We've found that they want some things that, if they've been doing this for a while, there are certain things that are important to seasoned investors. So we have some really cool features that we think that they like. Just a couple of things we are able to, if they've done a couple of deals with us, we are able to actually increase our loan to value on those guys. We have flexible pricing. It's just a little bit better program. Submit simple draw requests online and upload all your documents through a portal. This is very important in today's day and age. Whether you're doing a hard money loan or you're doing your conventional loan, all your documents can be submitted securely through a portal. And your draw requests as well. You could actually log in if you're at the site trying to go through the property with your contractor. You can log into your portal and select the things that have been done from smartphone, hit submit, and boom, we get the order. There's no going back to the office and faxing or scanning. It's all handled online. And the up to 100 financing, yeah.
Oh, on that topic, will you explain what a draw request is and how and why it's needed?
Absolutely. So like Wade said earlier, a hard money loan is typically a loan where you're given money to purchase and repair the property. So let's just say in this example, there's a $40,000 rehab budget on this property. So at closing, we won't get into the machinations of all of the numbers, but basically at the end of closing, there is $40,000 sitting in an escrow account that we have ready to disperse to you once work has been completed. So let's just say, for example, you need to fix the foundation and put on a new roof, and that's going to cost $10,000. So if those are the first two things you do, once you and your contractor have completed those tasks, you can submit for a draw, which means we will give you the money for the work you've completed. So you go online, you say, hey, we've done the foundation, we've done the roof. Typically we send out either our project manager or we send out an inspector, not an appraiser. Those are two very different things. We send out an inspector typically to go and check and make sure that your contractor has done the work that they said they were going to do. If that's the case, typically within 3 to 5 business days, we will send you the $10,000 And then you can use that money to keep your contractor going until the project completes. Hopefully that answered the question.
Yep, that's perfect.
Great.
I might want to add one or two things to that. We work with a tremendous amount of out-of-town buyers, and I know that Leah and her team do as well. And the fact that we have these third-party inspectors or internal inspectors check the properties out, I think is a real value proposition in comparison to some other lenders that may be competing against us. If you're out of town, we do not take your place. We're not the most heavily vested person. You have to do your own due diligence, but it is great to have a second set of eyes that is not an appraiser that is great at determining values, but not necessarily trained and highly educated to see if the job is well done. And those are the individuals we use to help make sure that these projects go properly and that money is not paid for work that is not well completed.
Thanks for adding that.
No worries.
Yeah, and then like I was saying, the very last thing is the up to 100% financing available, no loan to cost requirements. A lot of times you'll speak with other lenders that no matter how good of a deal it is, you still have to kick in what's called skin in the game, whether it be 10% or 15%. So we have set up our loans to where we will lend you 100% of everything as long as it's underneath that 75 or for flips 70 loan to value number. So in the example I gave earlier, if you just get a smoking hot deal and it's under 75%, you don't need to bring anything to the table except for your closing costs. In some instances, if it's that great and you're a really highly qualified borrower, we will roll in closing costs as well.
And that's fantastic because there's a lot of loan to cost max that has gone into place lately. And that's because they want to make sure you have some skin in the deal. Otherwise, they feel like you're more likely to default. So still having that 75% LTC or loan to cost max is fantastic, or LTV, and then no LTC is fantastic. So when you hear those terms, you're going to see a lot of deals that are blasted out talking about LTC and ARV. That's what they're talking about. That ARV is the value after the work is done. And then loan to cost is actually how much you're going to have in that deal. And so one thing that a lot of people don't talk about is stabilized value. And so I'm going to add that one piece in here, that when we're dealing with certain lenders and certain projects, you're going to hear stabilized value as it pertains to multifamily. And so what happens is when you go to do a loan on maybe a 4-plex or an 8-plex, you're going to be able to get lending based on what the ARV is after the work is done. But once the work is done and it's fully tenanted again, the value can even potentially be much higher, and that's called a stabilized value. And that's what happens on the back end if you choose to cash back out again on the back end. So that's why you'll hear us use 3 different terms when we're talking about deals we send out.
Absolutely. On this next page, one thing that is really attractive is speed of closing with the hard money transactions. You know, Leah has some great banking relationships. I do as well. And in many of those, it's still difficult for them to close in the timeframes in which we can close, just because it's, you know, there's more bureaucracy and a little bit of red tape. So in instances where wholesalers are putting out, they have to close in a certain time frame because of a foreclosure or some other issue, this can really help your contract at a much higher level just because of the speed in which the transaction can take place. So keep that in mind whenever you're evaluating your different options. As we mentioned earlier, it's the money to purchase and to repair, and that numbers can be very large. And candidly, sometimes the larger repair numbers are the best deals. The more you differentiate yourself from the market of retail buyers, people that move into homes, and they typically want those homes to be relatively pristine. The more you differentiate yourself, the more you take those people out of the market. And you also take maybe newer investors that are afraid to take on more than a paint. So we want you to know that we're there to support you on the very small rehabs or very large rehabs. Hard money is more flexible, not regulated. I kind of talked about that a little bit. We covered these other items. A big thing is that if you're wanting to look at buying homes straight conventional, some of you guys may be wanting to do that. We can support that, but that most of these value plays that she's talking about are going to involve, a hard money to conventional purchase. We'll talk a little bit more on the next slides about how we integrate that process to be smooth and easy.
So these are our conventional financing options. Like Wade said earlier, we do hard money and we are a conventional lender. All of our loan officers are conventionally licensed, so you'd be able to work with the same person throughout the process. Conventional loan programs are the ones that you typically hear about, right, in the news, Fannie, Freddie. They are less inclusive approvals. You have to document your income. That's usually where most people have the hardest time. Most investors will do a 30-year fixed just to maximize their cash flow. To do a conventional loan, you have to do it in your individual name. You cannot, a lot of times we will talk to people that want to do loans in an LLC. Hard money is fine. You can do a loan in an LLC. We have no problem with that. But to do a conventional refinance, you have to put it in an individual's name. It cannot be in a business name. Conventional loan programs are usually 75% loan to value. You could go all the way up to 85%. The pros and cons. The pros are you get to keep more money in your pocket. The biggest con is that your rates and your payments are going to be a lot higher. So you really eat into your cash flow. If you try to creep up and keep more money in your pocket, you're going to make less money in the long run. There are different types of conventional lenders. There are what's called Fannie Direct and non-Fannie Direct lenders. We are a Fannie Direct lender, which means there are no overlays. And what an overlay is, the Fannie and Freddie will give us a set of guidelines. Everyone has these guidelines. An overlay is a company that has extra guidelines on top of what Fannie and Freddie are given. We do not have any extra guidelines. We deal directly with just the Fannie Freddie guidelines. What that means to you is that you can get clear to close before the rehab is complete. And the most important one, you can refi on an appraised rent rate versus it must be leased. Meaning if you're dealing with a Fannie Direct lender, you can do the deal without it being rented. You can do it on just what's called the appraised rent rate. On your appraisal, the appraiser will send in, you'll put as part of the appraisal what the estimated rent would be. And you can qualify in your closed your loan based on that, as opposed to a lot of non-Fannie Direct lenders, they have to have the property leased. Lastly, investor lenders versus big box national lenders. Every now and then we will come across an investor that wants to do a hard money loan with them, but they will want to use like Wells Fargo or Chase or their normal banking relationship to do these loans. We strongly discourage you from doing that. Most of the loan officers that you're going to deal with at the banks are not professionals. They have probably never even done an investor loan. They just aren't set up that way. There's a lot more red tape involved, and this is what we do, guys. That we specialize in doing deals for investors only.
For the record, the majority of deals that we see on the investment sales side that blow closing timelines or fall through are people who go to big box banks. So your Wells Fargos, your Chase banks, that is not who you want to go to for investment properties, not if you want a sure thing.
Absolutely. And I'd like to tie in a little bit of this Fannie Direct versus non-Fannie Direct lenders and talk a little bit about why that is so important in this 60-day process that we try to provide a very attractive pricing relative to most hard money lenders. The reason that we feel we differentiate us from some other people who may be in that 6.99% range is how quickly can they help you get in and out. And there's two key things that we do. We're going to talk about the bridge appraisal here in a moment. That bridge appraisal basically is a product where for all intents and purposes, it is one appraiser throughout the process, and it can allow us to basically refi much more quickly. But another thing that we have that a lot of other lenders cannot do is we can refinance your property before it is leased, and we can work your rehab simultaneously with our refi, and we can often close within a few days of you completing your rehab, which is very unique compared to most of our competitors.
Hey, I just want to interrupt with a quick market update. We closed the Dow with the largest point gain ever in history. Just thought I'd throw that out there for a minute while we continue.
Yeah, well, it's good news on top of other good news, so that's exciting for sure. This is one product that we want to dive into a little bit. A lot of times people think that they may not be able to qualify for conventional financing if they do not have a W-2. And there are a wide variety of ways that you can. One, if you're self-employed, a lot of lenders, a lot of competitors of ours, and especially those big box lenders, do not know how to properly look at tax returns and give you the add backs that can allow you to get qualified even as a self-employed individual. Our loan officers and our operations team, this is all we do, and we're very good at calculating that income, taking ethical ways to give add backs, being as creative as possible to make these loans happen for people that deserve them. We have another product that is very unique as well, and that is the ability for people who have larger tax-deferred accounts, 401k, KIOs, and if you're over 59 and a half years of age, there is a way in which we can get you qualified. It's a pretty attractive option, which look at your regular receipt of income out of that account for 60 days. So in other words, if you're taking $10,000 out over 2 consecutive months, that can become the income that we establish on that account. And then if you have it in stocks, bonds, mutual funds, you do have to take a 70% discount, but you would be surprised at your ability to qualify, even if you did not have W-2 income at that time. If you have, for example, maybe $257,000 in an account. Now, keep in mind that $5,000 would need to cover your other bills, along with the qualification for this loan, but we are able to use the 1007, which is an appraised rent rate, to wash out the payment, which means a lot more people qualify for this very attractive Fannie 30-year type financing, even if you do not have a W-2. And if anybody is on a retirement plan, we could definitely deep dive those specifics of this program, but it's more inclusive than you might think. I kind of blazed through that. Any other questions on that?
I've got a ton of questions. We'll do them all at the end.
No
That
worries.
way they have to get back to work. They can finish the presentation and come back and watch the questions later.
Excellent. Jeff, you want to take this page?
Sure. So a lot of times we will hear people say, hey, why don't I just buy with cash and then refinance conventionally? So what they're talking about is, okay, they got a distressed property. They're going to pay, I don't know, $100,000 for it. They're going to spend $40,000 to fix it up, and then they want to refinance it after the fact. So there are a couple of options. One, if in that scenario, if you refinance immediately, you can only get cash back up to your purchase price, closing costs, and $2,000 in hand. So if you bought a house for $100,000, you put 50 into it, and it's worth 200 at the end of it. If you wanted to do a loan and get your cash back, you would only be able to get the 100 that you bought it for, plus your closing costs and a couple $1,000s. So really stifling the amount of money you can get back on that deal by paying cash. The other alternative is if you wait 6 months. If you wait 6 months from the purchase date, you can refinance and get the full 75% loan based on the actual value. So in that scenario, if you waited 6 months, you'd be able to get a loan of 75% to the 150. Now, the problem, the potential pitfalls, A, is just if you don't have that kind of cash laying around, but B, even if you do have that kind of cash laying around, I don't know how many people I've talked to that said they wish they hadn't done that because it tapped out their funds that they have to use for investments, and other good deals were just coming across their desk and they couldn't afford them. They didn't have the money to do more deals. And so while yes, you save some money on hard money fees and payments by doing it this way in the beginning, in the long run, you kind of cut yourself short because you missed out on maybe a couple other properties you could have done in the same time, if that makes sense. Next, Leah.
Okay. So it is important that most of the people that we work with and that Leah works with often want to buy multiple properties at one time. And you can certainly do that with conventional loans. The great thing about conventional loans is that you can use the appraised rent rates to qualify to buy multiple properties. And we have customers whose debt to income ratio is just a shade below the maximum at 50%, but they can buy 20 properties between them and their significant other. So definitely ways to do that. It is important if you are going to try and buy multiple at one time, that you understand some of the rules associated with it. If you have significant income and debt to income ratio is not an issue, then you can close the refinances on separate days without issue. And you can always close hard money loan on any day. We do not worry about the hard money piece whatsoever. You can close one today, one tomorrow, one a week from now. That's all fine.
So let me interrupt with a couple questions or clarifications on this, because I know that people are thinking them before they type them. Number one, in the last crash, a lot of us heard the term rapid acquisition. Is that something that is a concern today, and what does that mean?
The question, I'm sorry?
The question is, we used to hear the term a lot, rapid acquisition, back in the last crash. And given some of the instability and things happening these few weeks, is rapid acquisition an issue, and what does that mean?
I have no reason to believe that it will be an issue. I think that the government is trying to prop up conventional loans and ensure that the product, as they have been defined for some, is at minimum as inclusive and not more inclusive. So there was a time in the past where there was some concern about a rapid acquisition during a mortgage crisis. And property prices were dropping drastically, and you and I both don't believe that that's really going to be the case in this particular circumstance. So what that is, it is not that they are worried about the current situation or that there are going to be any changes that got. With that said, I just want to define the difference a little bit more slowly, and I appreciate the question. For hard money, you can buy one in any particular day that you would want. There are two different ways that it can happen whenever you go to refinance those hard money loans into conventional loans. Some people have more than adequate income and they can close the refinances on various days because they do not need the income, the rental income, in order to qualify. If you do need the rental income to qualify and you have multiple properties in your pipeline at that moment, and that could even be properties that are under contract, not necessarily that you purchased yet, we have to include all of those into your debt to income ratio. The good news is if we close 4 on the same day, we can use that 1007 appraised rent rate to wipe out the, not wipe out, but overcome the payments, the principal, interest, taxes, and insurance on 4 properties at one time. And even if your debt to income ratio is close to 50, you can buy 4 at one time. So there's a way to get around that. Your loan officer will let you know your own individual qualifications. And if you are a person who can buy multiple properties and close your refinances on separate days, or if you need to close them all on the same day. Does that make sense?
Yep. And then the other thing that I wanted to touch on is doors, and I'll take this one just so I can make sure everybody understands. So there's a lot of talk that it's 10 doors per person. So if you and your spouse both qualify, that's 10 doors. Well, in reality, it's not actually doors, it's property and tax ID. And so if you buy a 4-plex and that 4-plex is 1 tax ID, 1 property, that does not count as 4 doors. So when we're talking about this commercial Fannie Mae loans, we're talking about single family, duplex, triplex, and 4-plex. We're not talking about multifamily. And how the tax ID and the actual ownership and lot of that property is actually laid out, that's what determines how many doors it counts as. So you could, in theory, have more than 10 doors if you buy small multifamily, meaning 2 to 4, not 5+. And so that's something to keep in mind as well. And then finally, as you buy more property, and Wade, I'll let you kind of cover this, but the more you buy, the reserve requirement of how much cash you have to have is going to kick up at certain intervals. And Wade, I'll let you kind of go over that.
Yes, that's definitely true. It's not as onerous as you might think, but we do have a slide that we'll actually cover a little bit later that covers that, because whenever you go from 4 to 6 and beyond 6, there are definitely ramp ups, but I think we'll just cover that when we go to the slide. I do want to mention one other thing. There's also a misconception at times that you can qualify for 20, only qualify for 20 conventional loans. And if you have 10 loans through another lender, that would not count towards your 20 conventional loans. At the end of the day, what they measure is the mortgage electronic recording service, number of recorded deeds that you have or notes, and then at the end of the day, they're going to check that number. So it really depends on if your alternative lender is reporting to the MERS service or not. But we can let you know that whenever we're working through the process of letting you know how many loans you'll be able to do.
And just to clarify, for those of you going through our commercial lenders direct through banks, they do not report to credit.
Yes. Which is good.
Yeah.
But you're still
Right. Let me
able
tell
to take
you,
advantage.
about a year, maybe almost a year ago, I got kind of an itch to use some of my Fannie slots. It's like, I've got them, why not? So I rapid purchased like 6 or 7 properties, maybe, and my credit score tanked. And I wrote to the lender, I said, what in the world is going on? This is ridiculous. How could this happen? And he said, just be patient, give it a few weeks. Because for me, I have very good credit, and it's very important I have very good credit. And so anyway, 2 of the properties I did were properties I bought. I was going to flip them. I decided to keep them. So they're like $600,000-$700,000 properties. And so basically I added $1 million in debt in 10 days and my credit score went down. Of course, it came right back up. But that day right there, I decided, you know what, Fannie Mae and me are done. But when you're at my volume, it's a very different play. For most of my clients, they're still operating and utilizing those slots in conjunction with commercial so that they can do the multifamily there and the single family and the fixed 30 here with Fannie. So it's interesting to see how things change, but definitely something to keep in mind.
Yeah, and I do want to touch on that. With our single point of contact model, we really try to minimize the impact of the FICO scores. We try to limit the amount of pools. We just do one pool. That pool allows you to get hard money loans and permanent financing. And if you're buying multiple properties at once, we do not have to rerun that credit pool for 120 days. So if you were to buy 8, 9, 10 properties, whatever the case may be, in a very short time frame, you would be able to use that same pool as long as we don't go below beyond the 120th day. On our hard money side, we actually use that same credit pool for up to 6 months. So keep that in mind. We really try to limit the pools and keep the pools in the same category, which minimizes that impact as much as possible. Also, we can use that same pool in many instances on our multi and commercial products as well. So that's a lot of our customers like that they can have the least impact possible while still just working with one company.
Well, and most lenders that deal in Fannie Mae, they're going to pull you every 45 days. So you guys are doing almost 3 times longer. So that's fantastic too.
Yes, we know that for investors, to your point, one of the most important things you have is credit. It's right up there with cash and to do deals. And we want to do everything we can to keep it there, because if we adversely impact your credit, then we aren't able to help you do more deals, and that's bad for both of us. So it's a commitment we really have. Next, I want to cover this appraisal, which is something that we think is very innovative. We worked a lot to get this in place, and it's a product that mitigates a lot of the risk that people have whenever they think I'm doing 2 separate transactions, right? You think I have this hard money loan, which is unregulated, and oftentimes, you know, whenever things are unregulated, there might be an instance where someone says to an appraiser, this is the value I need, or whatever the case may be. Throughout this process for us, we have a highly qualified panel of appraisals. That's where we started. These guys know the business. They are deeply experienced. They're not afraid to walk into a home that you would consider an ugly home or a disgusting home. They've done it countless times before. To appraise the value based on the repairs budget, what a home can be, not what it is today. And you have to start with that level of competency if this program is going to work, or any program, honestly, if you're using properties. But what we're able to do is the program and the conventional design to have the same appraisal. And while I cannot guarantee,
Can you hear me? Yeah, you keep cutting out every few words. Can you go back and repeat that?
Yes, I'm sorry. Maybe my hand gestures or my head movements when I got excited about this bridge appraisal caused me not to be speaking. Is that better?
Yeah, that's perfect.
Yeah, that's way better.
Sorry about that. So let me talk about the bridge. I'm sorry if it's redundant for some of you, but I'm going to go through this. So what this is it is a product to mitigate the appraisal risk of coming in lower when refinancing. So In most environments where you're doing a hard money and a permanent financing appraisal, they're two completely independent appraisals. You have a hard money appraiser, which is unregulated. Sometimes that means that there's a little bit more interaction between either loan officer or some other person and the appraiser. And we really mitigate that in having a air compliant appraisal throughout the entire process. It's meant to be the same appraiser for both the hard money and the permanent financing loan. But where this really starts from, and the building block of what makes this different, is that we have a highly qualified panel of appraisers who have been doing fix and flip or fix, flip, and rent type properties for their majority of their careers. They're not afraid of dirty homes. They're not afraid of nasty homes. They've seen huge rehabs, and they have the ability to visualize what the home will be based on the repair budget, not get fixated on what it is today. Another big difference is that if there is an assignment involved in the transaction, most traditional appraisers don't really know what that means, and they will only see the recorded purchase price, which does not include any assignment fees paid to wholesalers. Our guys know that game, and they do not get overly fixated on the purchase price. And in the example that Jeff mentioned earlier, where you purchase a property for $50,000, you put 50 into it, and you think it's worth $150. For many people, new appraisers that don't understand this business, they just see that $50,000 a purchase price and they want to lowball that appraiser. Our guys did not do that. They're going to give a fair and ethical appraisal, assuming that we are going to help you do a good rehab based on that rehab budget, and they're going to compare it to the appropriate comps, which if you're doing a good solid rehab are going to be top of market comps. So we really don't see problems with that. And in an environment that may be changing, our customers love this product because you do not have to rerun comps for 120 days. So that means you do your upfront appraisal for the hard money loan, and then at the end of the day, there's just a final inspection as that step 3. As I mentioned earlier, this, along with the fact that you can refinance without the property being leased, are two very big differentiators between us and the competition. To compare, in its simplest terms, a competitor would wait until you complete the rehab. They would order for a new appraisal. Then it would go through underwriting. Then it would go to draw docs. Then it would close. That process, especially in the current environment, could be 2 weeks. It could be a month, or it could be longer. Conversely, we're actually able to get your file cleared to close before you have completed your rehab, which means that it does not have to go back through underwriting. The appraiser just does a final inspection to make sure that the work is properly completed, and then we are able to refinance you in many instances within a few days of you completing your rehab, which is a big deal when we're doing a 6.99% introductory rate, and then we have an increase of the rate after that 60th day. And most of our customers, as long as they're working diligently to get their rehabs done, are always able to get in and out before there's any rate adjustment. Anything to add to that, Jeff?
No, I got muted there. No, I just like it is a way to make sure that one of the biggest pitfalls that buy and hold investors have is hard money appraisal coming in high, then the refinance appraisal coming in low, and at that point there really aren't a lot of options. You have to come to the table with that difference. So this is a huge weight lifted off a lot of investors' shoulder.
Yes.
Yeah, I totally agree. And just when we're looking at traditional hard money lenders, they don't have this as an option. And I think many of them that did maybe have this at one point, they're not going to be able to offer it right now. And so really, the biggest piece of all of this, so that everyone understands the importance here, is the bridge appraisal process and having that appraisal up front, because it basically makes it secured and it makes it guaranteed, as opposed to waiting for an appraisal on the back end where you're very subject to two different opinions. And, you know, when the same appraiser doesn't go back the second time, not only are you paying for it twice, but you also have the anxiety and the concern over what it's going to come in as. And for those of you that have known me for years, I talk a lot about the fact that no no investment is good if you are concerned or stressed or uncomfortable with it. And so one of the biggest stressors I see for people in that rehab process is worrying about getting the rehab done, getting that end appraisal done, where the value is going to come in. And this process basically takes away all of that emotional piece, which, you know, especially in times like this, it's extremely important, I think, to limit our stress in every way we can and to know black and white going in day one what to expect. It's priceless.
Yeah, well said. We have a lot of customers that they won't even do a deal unless it's on this bridge process because they like it so much.
Yep.
Yeah, so a couple of things that we talked about earlier, just around the timing. Credit reports, 110 days from the date the credit was pulled. Technically, we can get an exception to 120. It is an exception, but we are able to do that in instances. And then hard money for 6 months. Get your rehab done ASAP so you don't have to pull credit again. And also, you don't want to have that appraisal, updated comps. There are some instances where we might be able to get exceptions at times at the 120 days. But the only certainty we have is that we do not have to within that first 120 days. So I think that's imperative that you work diligently to get it done as quick as possible, as I'm sure you guys always do. Things that can affect your refi that you do need to keep in mind, making large purchases or putting additional properties under contract. That's one very key thing with Fannie Freddie. You do not have to have a loan out on your property for it to be counted into your debt to income ratio. You will sign a document at closing that says you have no other additional real estate obligations. So you want to make sure you do not have those. If you are going to purchase additional properties, which we encourage, we want people to be able to add properties. It's just important to go into it with a game plan and to make sure your loan officer knows as soon as possible. But there is always a last minute verification of job. They do soft pulls to just see if there are any additional inquiries. It doesn't count against your credit, but if they see multiple inquiries, they're going to ask questions if you incurred additional debt. Make sure you don't have any late payments or reduce your bank balances or anything like that. If there's any doubts, just call your loan officer. But for the most part, it's just making smart decisions around additional purchases and anything that changes your financial situation during that time frame.
So
Yep.
hard money, yeah, sure. So hard money to conventional financing, like we kind of talked about a little bit on the appraisals, they're ordered as soon as the rehab is complete. Let your loan officer know immediately or before the rehab is complete. So we can be prepared. We want to get you closed as soon as possible for a bunch of different reasons. But and we kind of the backside appraisal can vary from the front side. So this is kind of what we're talking about. If it's not on the bridge. If you have a deal where the backside appraisal comes in high, well then great. You can roll some of your closing costs in. That's always the best case scenario. Low obviously is the worst case scenario. If it comes in without using the bridge, that means more money to the process. And then when the bridge process is kind of like the insurance policy against that risk that we work on. Other lenders, they usually don't use the same appraiser. We have set up our system towards air compliant. So this is all about nothing shady going on. And then, like I said, if you don't use the bridge, new comps may have hit the market, which may seriously impact the value. So you want to make sure that if you're working with us, any way we can use the bridge process, do it. Yeah, hard money to conventional financing, assets and reserves. They need to be seasoned for at least 60 days. Like we said earlier, any large deposits must be sourced. You're going to be asked about it. A lot of times it's draw money, which is totally fine. But if there's anything else, a large deposit, just be ready to source that. You need to have money to purchase and refi all the transactions. And you must have money to meet the Fannie Freddie reserve requirements, which I think are on another slide. The rental income must show a positive on the tax return, and it will be considered a debt. And then Schedule E is a fair rental days. They must be accurate. So you just got to get your tax returns over to your loan officer as soon as possible so they can analyze them and make sure that you qualify up front. And we always do that before anybody does any deals with us. We really take a lot of time with making sure that you're pre-approved because we don't want to put you into a hard money deal and then have a hard time getting you out of it with an approval. So we really take our time with that and make sure that that's solid. Wade, do you want to cover the conventional loans?
Actually, I was going to go back to the previous slide if I may momentarily. So I want to just talk about these two last pieces of advice on your taxes. So one, I want to make sure that you do not think that if for some reason you happen to show a loss, that it precludes you from getting a loan. It just bakes into your debt to income ratio. And you know, your CPA and sometimes our own personal objectives around reducing taxes are not always in line with being qualified for a loan. But there are many things that you can add back. Depreciation is an add back. So generally, I'm not a tax attorney, but or a CPA or anything of that sort. But I would say that the Lifestyles methodology and other guru organizations will generally tell you that writing everything off as an expense in year one is going to make your tax returns look very bad. And you can depreciate that over time, and it's going to put you in a much better situation to qualify for loans. So it's just something very important to keep in mind. And make sure that your CPA is putting in the fair rent days, because that is what Fannie requires us to use as far as calculating. So what that means is, how many days did you actually have that property on the market, right? And then they're going to use that number to determine your monthly income. So if you have it vacant for a certain period of time, that's not counted against you, but your CPA has to properly, or you have to properly input that information, make sure the days when the property was vacant are not included in that fair rent days number. Okay, we can go on to the next slide. So conventional loans 0 through 6, your primary loan is going to be included. What we've done for a lot of people in many instances is, if they're wanting to max out their 20 Fannie Freddies, we can potentially do a refinance and take the one significant other off and put, you know, so that one can have 9 plus the primary and the other can have 10. We always encourage you to do the deal separately between you and your spouse to maximize the number of deals that you can qualify for. We can calculate the rental income using the lesser of the 1007, which is the appraised rent rate. The appraiser is going to go out and you look at comps, just like he determines the value of the property, he will determine the rent rate. And then we do have to include a 25% vacancy factor in that number to determine the rent that we will use to counteract the debt and to count into your overall debt to income ratio. So using even numbers, you're getting $2,000 in rent, we're going to be able to use $1,500 because of the Fannie required vacancy factor. The reserve requirements, you have to have 2% of the aggregate unpaid balance on all mortgage loans on deals 0 through 4. Whenever you bump up to deals 5 and 6, that number goes to 4%. And then when you go to the next page, we will see that those numbers go up. We have a comment here from MERS. That is the place in which these numbers are determined. So it's every mortgage recorded with Mortgage Electronic Recording Service. On the previous slide, I did not say this, but there is not a hard minimum FICO. It could, you know, typically it's in the mid 600s. There is not a hard minimum, but typically you can have high level of confidence that if you're at 650. On this next page, we do talk about the minimum FICO for loans 7 through 10 is 720. Couple things that do change. Reserve requirement is 6% of the aggregate unpaid balances. And if you count your primary, you can get up to 20 total loans between spouses. We've helped a lot of people max that out.
Yeah, I wanted to make one point on the alternating them in between your spouses. Both spouses have to qualify individually. So if both spouses work and have enough income to qualify, that's great, but otherwise it would not work. You have to be able to qualify for both spouses individually.
I've seen many people that do the first ones individually, and then as it gets tighter, maybe they don't qualify individually for the next ones, and so they do the final few combined. So there's different ways to angle it too.
Yep.
Great.
That makes sense. So conventional multifamily financing options, these are multifamily deals. They're typically much larger with more cash to close required. Appraisals and surveys are a lot more expensive, usually a couple $1,000 as opposed to typically most regular appraisals are around $450. To do conventional loans for multifamily, it is more difficult to qualify. There are a lot greater net worth requirements. to do these deals, but they are a great way to continue investing if you want to move on.
You
We
will
can help
not
you with
see us
multifamily
recommend
as well.
conventional for multifamily, just FYI. So those of you that are used to our traditional multifamily lending options, we are not going conventional. We go direct through banks.
Fair enough.
Yeah, and so our typical, just to kind of give some idea, our typical loan to cost max is around 85 to 95%. So depending on the deal, depending on the repairs, depending on what's needed, and depending on your qualification, you could get in with 5% down, 15% down. It just depends. It could be as much as 25% down. It's all about the deal. Multifamily, the value play, the swing is much larger. And so for those of you already working on those deals with us, we've already kind of talked about that, but just want to throw that out there that there's lots of different ways to do multifamily financing. Right now, most people are going direct bank. Rates have been real volatile on the conventional side for multifamily in terms of going up.
Okay, so just a few other things. As we mentioned earlier, we have a secure and intuitive online website and our webpage. We have gone through great efforts to ensure that you can do everything from a smartphone, tablet, or mobile device. All documents are uploaded straight to your secure portal, so you do not need to email anything. And we have SAS 70 level protection to ensure that the data is protected. We can only get you a pre-qualification in as little as 24 to 48 hours. And then, as Jeff mentioned earlier, submitting the draw request from your mobile device is a big deal. And while we have emphasized technology, you know, in summary, before we move on to the questions, in my opinion, the biggest differences in our company, and I think it's also one of the biggest differences in OmniKey, is the teammates that we have. They're very knowledgeable, they're very passionate, and they're trusted advisors. If you are unsure of the best way to approach our lending options, they're going to take a lot of time to explain them to you and to help make sure that you feel comfortable so that you can move forward with confidence.